Hello and welcome to this Astranti video where we'll be looking at what depreciation is and how it's accounted for. Okay, so depreciation is a really important part of accounting for non-current assets, and it's something that students often struggle with the first time they come across it. So we're going to go nice and slow here to make sure you understand it first time round. So depreciation, another way of saying depreciation, is the systematic reduction of the value of a tangible asset over its useful life. Now that may seem simple enough, but an example should show you why it's important that we do this to non-current assets. So we have our example, Company Z, and they buy some new machinery and it costs £300,000 to buy the new machinery. So let's take a look at the impact of that on their financial statement. So these are the lines that are going to be affected. So in year one, the company made revenue of around £500,000. So not a bad year for revenue. And of course, this is the year that they purchased their non-current asset, their new machinery, and that cost £300,000. So we have to show that as a cost. And then there were other expenses of £250,000. So once you take all of this into consideration, the company has made a loss of £50,000, mostly because of the cost of this new machinery. Then in year two, the company's revenue has gone up a little bit. They're slowly increasing their turnover, which is good. Didn't buy any new machinery this year, so they're not going to include any cost for that. And their other expenses also went up at a kind of incremental rate. So overall, the company made a profit of £245,000. So what's happened here? Because the company's purchased such an expensive asset, and remember, non-current assets generally are going to be quite expensive. In year one, they've expensed it, and it's made them make a loss. It's impacted their expenses so much that they've actually made a loss. Whereas in year two, they've jumped back up to probably where they normally would be if you don't include the expense of new machinery. They're just the incremental increase in revenue and other expenses. So this is what happens when you record the entire cost of a non-current asset in a single year. It has an unrealistic impact on a company's bottom line. Well, let's take a look at what happens if we spread the cost of the purchase of an asset over several years. So let's say it's the same situation. It's Company Z. They buy the new machinery. It costs £300,000. But instead of expensing the entire cost in the first year, we're going to divide that cost over the number of years that the company expects to use the asset. Okay, so in this case, Company Z expect to use the asset for 4 years. And so if we divide £300,000 by 4, we get an expense of £75,000 a year. So let's look at the impact of that. So the revenue is the same in both examples. The depreciation, rather than the entire expense, we just have depreciation for 1 year of the non-current asset. That's £75,000. We have the other costs. They're the same, £250,000. When we get to the bottom line, we see the company's actually made a profit here. Let's look at year two. Year two, the revenue, same as in the example before. Depreciation again of £75,000. That's the second year of depreciation out of the 4. We have our other costs. And look here, the company again has made a profit. We do the same in year 3, and the revenues increased. The depreciation's the same. The other costs have increased slightly, and the company has again made a profit. We do the same thing again for year 4, and at this stage we've had all 4 years of depreciation. We add all these together and it costs £300,000, which is the original cost of the asset. And so spreading this over the 4 years means you get a more accurate representation of the company's finances, because since that machine is being used over 4 years, then you might as well spread its cost over 4 years rather than all in one, because it's going to mess up your bottom line. It makes you look like you're loss making 1 year and then you're making a huge profit the next year. Whereas if you have depreciation, you spread that cost over the 4 years and you have a much more realistic representation of the company's financial position and performance. Okay, so that is the key idea of depreciation. And when we say the systematic reduction of the value of a tangible asset over its useful life, that is what we're referring to. It's important that you don't confuse depreciation with a loss in value of the asset. It's purely an accounting technique. It's not any signal that the asset has lost significant amounts of its value. It's not a reflection, for example, of the decrease of the value of that asset based on market valuations. That's not what depreciation is. So the depreciation charge is shown as an expense in the profit and loss, the income statement, as we just saw, but it's not allowable for tax purposes because it is an accounting technique. It's not an actual expense. When it comes to calculating tax, you add the depreciation charge back on and you get what is called a capital allowance for tax purposes. But we don't need to worry about that. This isn't a video on how to account for tax. And depreciation starts as soon as the asset has reached the location and working condition it requires. So more or less, as soon as the asset has been recognized and is initially measured in the books, then it's going to be depreciated, usually at the year end. Okay, so by now you may have figured out that this is going to have an impact on the subsequent measurement of an asset, because subsequent measurement, remember, we had the either, depending on the model, the historic cost or the revalued amount, less accumulated or subsequent depreciation and impairment. So what we need to do now are look at the different ways that assets can be depreciated. We looked at one in our example, but that's just one of many. So let's look at all the different ways or acceptable ways of depreciating assets. Okay, and before we do that, we need to get to grips with some key terminology. So we have what is called the useful life, and the useful life is simply the duration that the asset will be purposeful to the business. So how long the company expects to be able to use the asset, that is its useful life. Now, most tangible assets have useful lives that are limited to between 2 and 20 years. And all these assets are subject to depreciation, but it doesn't always correspond with how long the asset will actually last. So you could have a computer that could physically last for 20 years, but due to the speed of technological advancement and changes, the computer might only be truly useful for about 3 years. And therefore, in that situation, the useful life would be 3 years, not 20 years. Additionally, the useful life should be periodically reviewed by the company, normally around the statement of financial position date. And this way, any significant changes on future depreciation charges can be adjusted. So you have to keep on top of the ongoing useful life of your non-current assets. We have the residual value. That's how much the asset will be worth at the end of its useful life. So for example, if you buy a car and you have it for 10 years, you may think, well, at the end of that 10 years, it's not going to be completely worthless. It's going to have some residual value. You might be able to sell it for some amount of money. That's what we're talking about there. So let's look at an example. So we have a motor vehicle that has a cost of £3,000 and a useful life of 5 years. So they expect to use it for 5 years. This vehicle can be sold back to the car dealership or used as a deposit for a new car at the end of its useful life, so after 5 years. The agreed upon residual value is £400. There would also be a collection fee of £50. So let's look at what we do here. So the residual value of the vehicle will be £350. Why is that? Well, we have the £400 agreed upon residual value. That's how much you're going to get back if you sell it back to the dealership at the end of the 5 years. But there is the collection fee that will reduce that. You're going to have to pay a collection fee. So what you do there, you basically cancel them out and you say, okay, well, let's say it's a £350 residual value and that accounts for the collection fee of £50. So the depreciable amount will be £2,650, and that's calculated by taking the original cost of £3,000 and subtracting the residual value of £350. And then that will be divided by 5 to get your annual depreciation charge over the next 5 years. Okay, so that should have us familiar with the different terms. So let's look at our first method of depreciation, and that is straight line depreciation. And this is just the example we looked at. So it's cost less residual value divided by useful life. So if we take an example, we'll say the useful life of an asset is 5 years. The residual value is £50 and the original cost is £500. That means when we put all that into the formula, we have 500 less 50, 450, divided by 5 years. That gives us a £90 depreciation charge per annum. Okay, so that's the basic idea behind straight line depreciation. So if you found that video useful, we have many more videos like that one on our YouTube channel. So give this video a like and subscribe to the channel if you want access to more of that content. We are also around in other places on social media. We have an Instagram page. We are available on Twitter, and we have a number of Facebook groups related to which particular level you are at. So if you're an operational student, have a look for our operational group where you'll find useful content there. And of course, you can find us at our website, www.astranti.com, where you can get access to many free materials.